All right, well, welcome to BMGT 443, also known as Applied Equity Analysis. My name is Joe Perfetti. I will be the faculty for this semester. This semester, I have 4 sections, and you can see that on the syllabus, which I posted recently, both here as a PDF file, and it's also on the syllabus link in Canvas. So if you go to Canvas and you click on the syllabus for our course, go to Canvas, and for fall 2013, click on the syllabus link. You will see the syllabus there. You can also find files which include the syllabus in the files section. I also created a folder in the files section called lecture notes, and we will be going through lecture 1 in just a few minutes as part of our introductory class today, but all lecture notes will be posted in the lecture note folder, and I'll generally try and post them Sunday night before the following classes on Monday. So again, purpose of today is to give sort of a brief introduction to the class and also to go through lecture note 1. So let's talk about equity analysis. Again, my name is Joe Perfetti. I'll be the faculty, and I think this is my 6th year teaching this class. Basically, I kind of have 3 backgrounds. I teach this class for the undergrads. I got 4 sections this semester. I'll be teaching an MBA part-time version later this semester, and I also do a version of this for the Masters in Finance program here at Smith. This class is really called Equity Analysis, and it focuses on 2 major things. One, to help you kind of understand the buy, sell, hold recommendations that the analysts put out there, kind of how they do them, and that actually will be one of the things we'll practice this semester. The other thing is it'll help you understand some of the principles of valuation. I also have sort of 2 other jobs. My second job is I do what's called executive education. This week I'm in San Francisco working with a bank called Minsheng Bank. I'll be working with Chevron next week. A little bit later this month, unfortunately, I have to go to Thailand, and I'll be working with Siam Commercial Bank and a few others. So one of the things I do is I do a lot of real world work for companies, which I will be bringing publicly available data into the classroom. Because again, the key word to this class is applied. By the way, my third job, so to speak, is that of entrepreneur. I'm on my 3rd startup. First startup did okay. We're a little ahead of our time. Second startup was venture funded. Ended up raising about $29 million of venture capital and sold that company off. It still exists today, and we're actually just starting up our 3rd business. So I mentioned that as well because in addition to teaching and being a practitioner, had to raise capital, had to deal with investors, had to run a company. So again, I want to try and make what we do during this session as practical as possible. Primarily, what we're going to focus on this semester is, again, the key word is applied equity analysis. We're going to kind of build everything you've had in your undergraduate career, and this class is going to apply it in an integrated fashion using real world data on real world companies. And I'll go through that in the syllabus in just a second. So that's my email address here in the syllabus. If you need to reach me, I'll close out my email. If you need to reach me, back to the syllabus. That's the easiest way to do it. That is my cell phone. The office is 4468 Van Munching in the finance department. Generally, I will only be on campus on Mondays and Wednesdays, and my opportunity for office hours is before the 11 a.m. section. You'll notice that I do have 4 sections that run essentially consecutively, starting at 11, 12:30, 2, and 3:30. We'll have 2 TAs this semester, Brittany Flack and Brent Rebel. They were both students that did very well in the spring semester, and I have carried them over into the fall to be your TAs. So in addition to helping you, they were in your shoes not too long ago and really have a good understanding of the material. Brittany will have office hours Wednesday 12 to 2. She'll also be in my office 4468, and Brent's office hours will be Thursday 3 to 5. That is their email address and their cell phone numbers. In terms of the course, What we're really going to do is we'll cover four major topics this semester. The first is to introduce you to a framework known as EIC, and that will help you understand that about 50% of a company's performance is going to be based on sort of the industry conditions. And the industry will drive a lot of the profitability and drive a lot of the valuation. So we'll give you a framework for understanding the industry. Second, we'll talk about doing what we'll call historical financial analysis. In order to understand the future and do valuation, the past will give us a sense of the future. So we will do some historical financial analysis, and we will also convert accounting statements into economic statements to help us do that analysis, which will also make our valuations a little bit easier. Third, we will do valuations. You'll work on a semester-long project where we'll pick a real-world company. You'll pick a company that is publicly traded, and you'll create a valuation of that company using a valuation model we will develop in this class. And fourth, we will talk about multiples as an alternative to a cash flow valuation methodology. So we'll value companies using multiples. We'll also value companies using cash flow. The textbook that we're going to use is the valuation textbook written by McKinsey. It's in its fifth edition. The university edition is the one carried by the bookstore, but any fifth edition will do. The important thing, though, is you do need a fifth edition. If you get one of the older editions, it won't help you because the fifth edition was completely rewritten. And that is the only textbook that we'll be using this semester. You can buy it at Amazon. I actually use the Kindle version for this class for my own use. But any version of the fifth edition is fine, whether paper or electronic. Also, anything else that requires reading will be posted on, and I know it says Blackboard, it should say Canvas, since we're now using Canvas here at Maryland. The other cost to you this semester is that you will be doing a group project known as a stock track simulation. And you'll be putting yourselves into teams, which we'll talk about in just a few minutes. But each team of 5 to 7 people will have to sign up for the stock track simulation. The cost of that is $30.95 per team, or assuming 6 people, a little over $5 a person. That is the only other cost associated with this semester. To register for stock track, this is the link that you'll need to follow because you'll have to actually be associated with this class. You'll need one of your team members to basically register and pay with a credit or debit card, and then that will pay on behalf of the team. Okay. So, groups. You're going to basically work on 2 group projects this semester. And so again, 5 to 6 people is ideal for groups, no less than 5. You could potentially have 7, no more than 7. So something that you'll need to start working on is forming groups. On the first physical class that we'll have on Monday, I'll try and help some people get into groups if you're not in groups, but it is your opportunity to choose groups. What you'll see in just a minute is about 1/3 of your grade for the entire semester is going to be based on group projects. So obviously choosing the peers that you work with your groups is an advantage to you. So again, please start the process of meeting your peers and forming groups. There will be 2 group projects that you will work on, which we'll talk about in just a minute. The other thing that is going to be key to this class is paying attention to current events. I would recommend scanning the wallstreetjournal.com every day before class because we'll be talking about some of the issues in class, and bloomberg.com. Not recommending paying for wallstreetjournal.com. You can just kind of scan the headlines, but bloomberg.com is also a free site and probably has just as good of business information as the Wall Street Journal. And at the beginning of many classes, we'll talk about some of the current events. So for example, if we were to jump over to the wallstreetjournal.com today, one of the things that we'll probably be discussing next week is the fact that Microsoft is buying the phone business of Nokia. And that's kind of a big deal in many ways. Steve Ballmer, if you probably have been following the news, announced that he is leaving Microsoft. And one of the things he's doing before he left is that Microsoft, which has about 2% of the mobile phone business and seems to be irrelevant, is trying to struggle for relevance. So they're buying the handset maker Nokia. Probably going to buy Research in Motion's BlackBerry soon too. But in any event, that's one of the things that we'll be discussing. Another thing that's going to be important for us to talk about are economic conditions that affect stocks. And one of the things that's going to be key is what's been happening with treasuries. Everybody's been following the yield of treasuries, but they're hitting almost 3% in the 10-year. And that is also affecting the stock market as well. So we'll be talking about specific company news that's kind of relevant to valuation issues and some macro indicators that are affecting the market as well. So back to our syllabus. All right, YouTube. This class is following the initiative to use technology more in the classroom at Maryland, which means a couple things. One, I'm going to be recording a lot of classes and posting them on YouTube. Originally, I was using iTunes U, but iTunes is completely unreliable because it's managed by our Office of Information Technology. And so YouTube, which is managed by Google, is far more reliable. So we are going to use YouTube to help us post and view all the videos. We'll also do some webinars from time to time. This is one of the webinars that we're doing. Part of it has to do with my schedule. Part of it is because I'm going to bring in some outside guest speakers. I am hopeful to line up somebody from CSX to come and talk to us. I'm also hopeful to get somebody from Lockheed Martin to come talk to us throughout the semester. And I have a former student that is doing valuation work for a real company, and I'm asking her to come back and talk to you guys as well about just what it's like to be a first-year analyst. So essentially, from time to time, I'll have some guest speakers. The advantage of using the GoToWebinar product, and I'm not using the video right now, but we can video this and record it so that if they can't make all 4 of our sections, then at least our guest speakers can be posted online. And so again, some assignments will be on YouTube, so you will need to watch those. Advantage, you can do that just about on any device. For grading, grading is based on a 100-point system, and the points are going to be allocated as follows. 10% of the grade is attendance, and attendance is really critical in this class. And I say that because it's a process class. What I'm going to be teaching you throughout the semester is a process to do analysis and valuations of companies. And what that really means is that the process kind of builds on each other. And so if you miss a substantial portion of the class, you'll be completely lost. And so I just want to make sure that while we're in the drop add period, if your goal is to basically show up on the first day and show up for the exams and miss everything in between, this is really not the class for you. You should drop this class. This class builds on each other. All of the material is cumulative. We're going to be building valuation models, which we'll be building over a 3-week period of time. And if you're going to miss a substantial portion of this class, you really don't want to attend this class. So I'm just kind of stating that up front. So we do have a pretty strict attendance policy to encourage people to attend this class. Second, there will be 15% of your grade will be based on a series of homework and in-class assignments. That will basically be working on things that help you apply the material that we go throughout the semester. Those will be spread out over time, and I'll give you advance warning when the graded assignments start, but you'll be taking those and submitting those on Canvas. 20% of your grade will be the midterm exam, 10% will be the stock track simulation, and 20% will be the group valuation project, and then the final 25% will be the final exam. So in terms of the simulation for stock track, what we're going to do is it's a real world sort of valuation exercise. When you sign up for stock track, you'll be given $1 million hypothetical dollars as a team, and trading will start early in the semester, and you'll have the semester to trade. And at the end of the semester, we'll stop the trading, and then it's grading is based purely on relative performance. If your team does the best, based on the amount of cash that you invest in real companies in the real world and have the highest portfolio value, you get the best grade. If your team performs the worst, then you get the worst grade. So it's based purely on relative performance. The group valuation project, as I said, is I will pick an industry. We will have companies within that industry. You'll then choose a company that's publicly traded, and you'll do, as I said, a kind of a semester-long project on that company. You'll turn in a approximately 12-page analysis plus the valuation model, which you'll have to print out another 20 or so pages once we get it done, and you'll make a 20-minute PowerPoint presentation. One of the things I'm trying to arrange is I mentioned CSX and Lockheed Martin. They have expressed initial interest in having their industries analyzed and possibly showing up for those final presentations, so that in addition to pitching your group projects as a grade to me, you actually might have some industry people in the audience that run these companies, or at least similar peers, and would actually be listening to your presentations and then could comment and discuss. I did this summer with my part-time MBA class. I brought in a company called Lane Construction. They did their analysis on the construction industry, had a senior VP, had a great dialogue after the teams presented on what were some of the challenges in the construction industry. And for those of you who haven't heard of Lane Construction, which you probably haven't, they were one of their big projects is they did the hot lanes over in Tyson's Corner on that Virginia corridor. But anyways, again, back to real world. Since we're dealing with real world data, I try and bring in some real world companies to help us do that. In terms of the attendance policy, as I said, way it works with the 10% of the grade is that everyone gets one unexcused absence. After the second unexcused absence, I start deducting 2 points of your semester grade per class missed for every unexcused absence thereafter. So 6 unexcused absences equals no attendance credit for the semester. Excuses generally come in one of two categories. I do excuse interviews. I know many of you are going to be looking for jobs, and so interviews are considered excused absences, with the caveat that you have to let me know before the class via email to myself and or the TAs that you will not be there and what the interview is, and then it will be considered excused absence. If you send the interview excuse after the interview and you miss the class, then I'll wish you luck on the interview, but I will still consider it an unexcused absence. Obviously, other things such as being sick or university approved events will also be considered excused absences. All right, final exam will be a take-home exam, and we're actually not going to do it in the university classroom. You'll have 7 days to work on it, and it will be a take-home final exam. The group simulation exercise, like I said, when you form your groups, you will need to sign up on StockTrack as a group and get your StockTrack account registered to this class. Please follow the honor code this semester, and I have a pretty simple late assignment policy. Anything submitted after a deadline will not be graded by myself or the TAs, and you'll just get a 0 for that assignment. So you don't have to worry about submitting things that are late. At the end of the semester, you will need to fill out a course evaluation, and very importantly, special needs. If there is anything that you need to deal with this semester, generally what you'll find is that before deadlines, I tend to be flexible. After deadlines, I tend to be inflexible. So if you have any special needs, please see me in the next couple weeks, and I'll definitely work to accommodate you. And again, as things arise through the semester, please try and talk to me before deadlines. All right, let's talk specifically about the structure of the semester. Today is September 4th, first day of class. Like I said, we're going to finish up the syllabus introduction in just a couple minutes, and then we'll get into lecture note 1. Next week, we will basically start on fundamentals of value creation. You'll notice for the assignments that I post some chapter readings. Generally, you should read the chapters before the Monday of that week, and then we'll use those chapters for both the Monday and Wednesday class. So next week we'll have a physical class in person on 9/9, and then Wednesday you'll be going to the finance lab. You'll have to watch a YouTube video, sign up for an account in the finance lab, and you'll be doing one of your first graded assignments. So that's what the case study represents, and that will be, instead of doing it physically in class, you'll be working in the finance lab on that assignment. So we'll talk fundamentals of value creation, just basic principles of what it means to create value. The week of the 16th, we'll introduce the EIC framework. And again, EIC stands for Economy, Industry, and Company. So again, about half of a company's performance and valuation will be detailing are detailed and impacted by external factors. And so we're going to be talking about what those external factors are and how they affect company valuation. Also, 9/18 will be the first day of stock track trading. So if you're not in a group by the 18th, I will assign you to a group. So again, we need to get the groups finalized by September 18th. Again, no less than 5 people, no more than 7 people in the groups. Okay. Then, week of 9/23, we'll talk about what we'll call frameworks for valuation. And there's going to be really 2 frameworks we're going to focus on this semester. One is called enterprise discounted cash flow. The other is called an economic profit valuation methodology. They're both used in the real world. EDCF, enterprise DCF, is probably the most used valuation, cash flow valuation methodology in the world today. So we'll talk about that this semester, and we will do our valuations based on those 2 frameworks. The week of the 30th is really a critical week. And what I've decided to do for the week of the 30th is that will be a YouTube class week. And that's going to involve what we call the reorganizing and conversion of the financial statements. What's really unique about this class versus other valuation classes is that we are going to do an extra step in the valuation methodology. And it's something used by McKinsey. And I used to be involved with the McKinsey Analyst Training Program, training their analysts that would work on their corporate clients, some of the financial principles. And this is basically the same stuff that they get in the ATP. And the idea is that in the McKinsey process, there's an extra step for valuation. And what they do is they take the accounting statements, and in most traditional classes, you go directly to forecasting cash flows from accounting statements. And one of the things McKinsey has done is they actually take the accounting statements and they convert them into economic statements, and then they use the economic statements to do the valuations. So income statements become a McKinsey statement called total income to investors. Balance sheets become total funds available to investors, TFI, and cash flow statements become what are known as cash flow available to investors, which is where we determine free cash flow. It's really a way of mapping the statements to the Modigliani-Miller model, and that's a process that some of you may struggle with this semester, but it really is going to be key to understanding valuation. So the extra step in valuation, it's a little bit more work up front, but what you'll find is once you do this step, it makes the analysis very clean and it makes the valuations very straightforward. And so that's really going to be one of the keys to the process this semester. And that week is really going to be a critical week. So everything will build based on that. For the following week, we'll talk about what we'll call analyzing performance and competitive position, which basically means we'll take the converted statements and we'll figure out what that means. And again, I'm going to send you back out to the finance lab to do this on a real company and to do some analysis once we've practiced on converting the statements using the textbook and some in-class examples. The week after that will be multiples. So we'll be talking about enterprise value multiples, PE ratios, PEG ratios, and how they are a parallel process to cash flow valuation. And then the week of the 21st will be the midterm exam. It'll be a 2-part midterm exam. So both days that week will be the midterm. Following that, week of the 28th, again, is when we're going to start building our valuation model. If you're not familiar with Excel, you're going to be pretty familiar with it by the end of the semester. So starting the week of the 28th, you'll need to either use a computer in our classroom lab or you'll have to use your own computer, but you will actually build an Excel-based valuation model that we'll use on real-world companies and use for your group project. So we will start building that model in class, and it will involve a series of homework assignments starting the week of 10/28. So week of 10/28, week of 11/4, and the week of 11/11 is basically the building of the valuation model. What we'll then do is starting the week of November 18th, we'll then take the model that we built and we'll build it using a real world company. So for example, in past semesters, I think we used Best Buy or Costco as a company that we'll all build the model using and value them using real world data, what we'll then do is we'll use the model to value other companies. So each day of class starting on November 18th, we'll pick a different company, and in class we use the model to value that company on a cash flow basis and talk about the valuations and talk about the buy, sell, hold opinions that come out of that. So really all of the theory of the class that we're going to teach you ends on November 13th. And then really we're just going to apply it to real world situations or real world companies for the next couple of weeks. Around the middle of the semester, you'll also have picked your company that you're going to do the valuation with. And so what we'll then do is you'll take the model that we're building, and then as a group, you'll use the model to help you do the valuation of the company and the analysis of the company as part of your group project. So you'll be working that over about 3 or 4 weeks. And then on December 2nd and 4th, that Monday and Wednesday, you will be making a 20-minute PowerPoint presentation on all of the analysis that you've done on the company that you have chosen in class. And as I said, I'm hoping to have, depending on the section, some industry representatives there that you also will be presenting to in addition to myself for the grade. So that's a very important week, December 2nd and December 4th. You really can't miss that week because those presentations are not going to be moved. And ultimately, as I said, we're probably going to have some guests there as well. And then the following week, we'll do a review, and then we'll hand out the final exam, which will be an electronic final exam that you'll take home and have about a week to do. And that will be the semester. The final page of the syllabus details some of the things that you're going to have to put together for that group valuation project, which again, we'll discuss more and more as we go through the class. So that's kind of a general overview of the class and some of the things that we're going to be focusing on. I guess, again, the key word here is this class, more than anything else, is going to be dealing with the real world. You'll be using real world tools, you'll be using real world data, and you'll be trying to make sense out of the real world numbers. And that's really what this class is about. We don't use Harvard Business School case studies here. We actually try and take all the frameworks that you've been learning in your undergraduate career and put them to work in practice. So it really is probably an interesting class from an integration standpoint. And from that perspective, you are going to be using a lot of real world data and the tools that the professionals actually use. You'll get an introduction to that. So that's kind of what we're going to be focused on over the next semester. So the other thing I wanted to cover today is what I'll call Lecture 1, kind of a basic intro to some of the principles that we're going to be discussing. So in the lecture notes section, I had posted those and pop up Lecture 1. I'll use the same PDF that I posted online. And again, this can be found on Canvas in the Files section for our class under Lecture Notes. I'll put the PDFs up there. Like I said, typically on Sunday. I know this one came a little late this week for our first day of class, but we'll have the lecture notes that we're going to use for each week there, typically by the Sunday of that upcoming week. And as I said, today what we really want to talk about is just some general principles that we're going to be discussing through the semester. So one of the things that I'd like to talk about is what McKinsey calls the 4 cornerstones of value creation. Because again, a lot of the work that we're doing this semester is based on the consulting firm McKinsey's sort of aggregation of all of the data. And one of the things that they do is they talk about there are really 4 things that are necessary to create value as an organization. And so we'll be focusing on those this semester. The first one is what's known as the concept of spread. If you can generate a return on invested capital, also known as ROI, greater than the cost of capital, then you will not be able to create value over time as a company. So all of you, in order to have gone to this class, had to understand the concept of NPV. And it's really just saying that NPV matters in the real world, that the internal rate of return, which is really what a proxy for ROIC, must be greater than the cost of capital for the company over time. Otherwise, you can't create value, just as you couldn't create positive NPV. And so that's what's really going to be key here, is understanding a company's long-term ability to generate a proxy internal rate of return, an ROIC, and comparing it with the risk-adjusted cost of capital that the company is overtaking. And what we're going to do is call the difference between those two spread. Value is going to be based on spread, and value is only created when we have a positive spread. Second thing we're going to talk about is that you really can't create value through financial reengineering. That financial engineering, reengineering is about rearranging cash flows. So for example, as Dell is trying to go private and the private equity firms are working to take Dell private, one of the things that they're doing is they're going to load the company up with a lot of debt. And by loading the company up with a lot of debt, they're going to create a lot of interest tax shields. And the interest tax shields are going to reduce the payments that are going to the government. In fact, the people that are going to introduce the debt to Dell are the private equity firms themselves, because they're going to pay interest to themselves. And the whole point of doing this is that by loading up with the debt and creating the interest tax shields, that the company pays less cash flow to the government, and the government gives the company a subsidy called interest tax shields. So the point is the company keeps more of the cash flows. And what I'm saying is that's not value creation. That is value redistribution, meaning the same amount of cash profit that the company generates before and after the company goes private, in this case Dell, is going to still be generated. The only difference is how you distribute that cash to the investors. And so really value creation is not about changing who we send the cash out to. Value creation is about having more cash to distribute. So there are cottage industries, and there are probably classes you've taken at Smith that focus on how we redistribute the cash that the company generates in a most cost-effective manner. I'm not saying that's not important. What I'm saying is what we're going to focus on is how do we generate more cash to be distributed, because that's ultimately what value creation is about. Third, we're going to talk about expectations. In the short run, the values of companies are not based on their cash flows. They're actually based on the expectations of the cash flows, and specifically the changes of the expectations. It's one of the reasons why I include Stock Track in the class this semester, is ultimately Stock Track is about understanding that in the short run, it's all about the expectations of the company, has nothing to do with the long-term values of the company. So if you're trading over a 3-month period of time, you're trading based on changes in expectations. You're not really you're not trading on changes in sort of the intrinsic values of a company. So here's what the research says. On the academic side, we know that if you go out over 10 years with big data sets, you see an almost one-to-one correlation between the cash flow companies generate and the values of these companies. So if you have big data sets and long periods of time, companies are going to trade for the cash they generate. Otherwise, there's arbitrage opportunities. We kind of know that. We've proved it out in the academic studies. But here's the problem. Today, I don't know what kind of cash you're going to generate over the next 10 years. So I know in 10 years, if I know how much cash you've generated, what you should trade for. But today I have to predict what those cash flows are going to be. So the value of the company is going to be based on my prediction of your future cash flows. And so here's the interesting part. Let's say we're able to jump 10 years into the future. At that point, what I care about is future cash flows, not historical cash flows. So I have to predict the next 10 years. So values of companies are based on the predicted cash flows. They're not based on the actual cash flows. And so that's why we're going to have to use some of the tools in the finance lab to get access to these predicted cash flows, because the free tools just don't give us access. And those predicted tools, essentially, the earnings estimates is the key there, are going to be key to what companies are valued on. So companies are going to be heavily influenced, particularly publicly traded companies, on the earnings estimates and whether or not those are changing over time. And so that's one of the reasons why we're going to have to get access to a service like Bloomberg Professional or Cap IQ or Thomson Reuters to basically understand what the professionals are predicting for the cash flows, because that's going to help us understand real value. So that'll be a third thing, and that's one of the reasons why we're going to do a lot of lab work this semester. Fourth, what this bullet really is about is competitive advantage. That over the long run, companies are going to earn their cost of capital. That's what the data shows. And in order to earn an above average rate of return, or in our parlance, a positive spread, you got to be good at something. So either you're in a good industry or you are better than your peers, or some combination of the two. That's why competitive advantage matters. So in an ideal world, we're almost taking a Warren Buffett approach to evaluating companies. Warren Buffett basically simplifies his entire valuation process into two steps. Step one, pick good industries. He is basically looking at a very long-term time horizon when he invests in companies. So ultimately, click this out. Ultimately, when he invests in a company, he's thinking about a very long-term time horizon, because Berkshire Hathaway, the company Warren Buffett manages, at its heart, he is transformed into an insurance company. And the way insurance works is that, say you do life insurance, you pay the cash in now and you give it to the insurance company. They're going to invest your cash for 30 to 40 years or even longer before they have to pay out a claim, person's death. So what insurance companies do is they do underwriting. So they got to make sure that they get more in premiums than they pay out in claims. But number two, they also get investment income, because they're going to invest their money for a long period of time before they have to pay it out. So the more investment income they make, the more profits they can achieve. But one of the things Warren Buffett realized a long time ago is that all of the other insurers out there could basically hire smart people from top schools to create essentially managed portfolios that earn market-based rates of return. So all the insurers with diversified portfolios, following the same diversification theories that you've learned here at Smith, are creating diversified portfolios that all earn the same rates of return, plus or minus a little bit. And he actually thought he could beat the market by making bets in individual companies. So Warren Buffett went against the grain a long time ago, and he said, look, I'm going to invest in individual companies. I'm not going to invest in diversified portfolios. That's Berkshire Hathaway. And so what he does is he picks companies that he wants to own. But he's not looking at an 18-month time horizon. He's looking at a 30 to 40-year time horizon, because he wants the duration of the company's cash flows to match the duration of the policies. So when he invests, he has to find a good industry, because if he's going to invest in the company, he needs that industry to do well over 30 to 40 years. So, for example, one of his most recent bets is a company called Heinz. Heinz makes ketchup. You're probably very familiar with it. You might say, gee, what is so exciting about Heinz? Well, what's so exciting about Heinz is ketchup you put on protein, hamburgers, things like that. And one of the things that we know is in the developing world, as people get more wealthy, they have more protein in their diet. And owning the protein itself, the slaughterhouses, is kind of a difficult and ugly business. But owning the condiments that go on the protein is not a sexy business, but at the same time, it's not a very competitive business. And Heinz has great brands. So what he's really done is he's made a long-term bet by buying into Heinz on growth in protein consumptions, particularly outside the US and the developing world. Rule number two at Warren Buffett: first, find good industries, and he thinks he's found a good industry for the long period of time. Second, find the best run companies in those industries. Heinz is a company that has great brands. Everybody's heard of Heinz ketchup. They've run the company very well. They've made a good amount of money. That's what he wants to invest in over time. So whether it's a Heinz, whether it's a Coca-Cola, recently he invested in a railroad. One of the reasons why I thought it'd be interesting to bring somebody like a CSX in here. But why do you invest in rail? Well, as oil prices have gone up, it's much more difficult to pay the cost of shipping, and the most cost-effective shipping is rail. And so he's made a bet that high energy costs are going to make rail more and more attractive as a form of shipping long term. So again, what did he do? He picked what he thought was the best run railroad. He acquired them. That's been his philosophy that's worked pretty well for him over time, and that's what we have to think about as we're doing our evaluations in the class. So finding good industries, finding companies with competitive advantage, key sources to value creation. The other thing we have to understand, though, is that value creation is also about managing trade-offs, and I call those tensions. One challenge that companies often have is they'll create these balanced scorecards. It's kind of like the hot new thing. The problem is you can't balance your balanced scorecard, because some of these ratios kind of work at odds with each other. And so we're going to have to talk about some of the tensions that companies deal with and some of the ratios that are odds with each other. So we'll get more into this next week, but basically one of the tensions that companies have to deal with is the tension of risk and return, which is earning a return on equity or return on invested capital greater than your cost of capital. Well, in order to get great returns, you often have to take more risk. So one of the questions is, how much risk do you want to take? So for example, yesterday, there was a presentation to the bank I'm working with by FICO, the credit scoring people. And one of the questions came up, which is, what's the perfect scoring model that we need so that we can maximize our bank's profits? But the short answer is the FICO people are like, just having a good FICO score and picking the FICO score as a cutoff isn't really the right answer to your profitability as a bank. The idea is you have to decide what is the level of risk tolerance you're willing to do, because that's going to talk to you about the types of returns, the types of products that you're going to be able to offer. So again, companies have to think about the level of risk they're willing to take and what kind of returns they can get for that risk. And they have to manage the balance between the two. Second tension companies have to manage is that between return and growth. And you can almost think of a continuum. On one side of the continuum are companies that focus on growth. Well, often these companies that focus solely on growth do it at the expense of return. And the other side of the continuum are companies that focus on return and they don't really care about growth. And the problem is they may not grow and they may struggle. So, two company examples I often give with this are a bank called Barclays, which is a UK bank that bought Lehman out of bankruptcy. And what ended up happening is that in the 2008 financial crisis, when all the other banks were forced, because they'd overextended themselves, to sell assets and lay off employees and kind of scale back and meet regulatory requirements, Barclays charged forward. So while everybody else was a seller, they were a buyer. And they had a CEO, his name was Bob Diamond, who was recently fired. But basically, his sole goal in life was to create the largest bank in the world. And despite the fact that the returns were poor, he thought that the financial crisis would quickly end, and that when everybody was selling by buying all the assets up, that and creating an even bigger balance sheet, that would lead to Barclays charging ahead. Well, 5 to 6 years into the financial crisis, the real problem is the world hasn't returned to its old ways, and we're still in a very difficult market. So what ended up happening is the more he bought, he was buying things at basically horrible returns, and the return on equity of Barclays went from about 11% to 4%. And as their return on equity fell, so did their share price. Their PE ratio also plummeted, and as a result, actually, recently he was fired. They brought in a guy. He's undone the growth. He's focused on profitability, and he's actually selling off some of the assets that Barclay has bought because their focus was too much on growth at the expense of profitability. You need to create a balanced approach. At the other end of the scale, you have a company like Clorox. Clorox, great American brand, makes bleach. Very profitable business, very sleepy business. But here's the problem that Clorox is facing, that after a decade of solely focus on return on investment, they set internal hurdles for their business, new product development, so high that basically they said, look, if you can't generate new products that have an internal rate of return as great as our core bleach brands that are on the shelves today, then we're not going to give you any money for new product development. So over the last decade, they've done almost no product development because they're trying to maintain the returns they're generating for the market because they think that's what's important to analysts. Well, over the last decade, their competitors like Unilever and Procter and Gamble have innovated, grown, and gotten global supply chain scale that Clorox just doesn't have. Now, Clorox is suffering. Their prices are being cut back, their margins are falling, their returns are falling. And unfortunately, they don't have any product development to then compete with the innovations of their peers, and they're scrambling to catch up. So here's an example of a company that focused solely on return. They didn't really worry about growth. And as a result, that return is now suffering because they didn't strike an appropriate balance. And so one of the things we're going to analyze is where are companies on that sort of return growth continuum, and what does it really mean for them in the future, and do they have an appropriate balance given the nature of the industry and the nature of their companies. The third tension we're going to get into is what we'll call short versus long term. Obviously, we have to meet our quarterly results, but we're running both sprints and marathons simultaneously as companies. So we have to look at not just how we're doing in the short run, but how our companies doing in the long run, and they have to balance the two. So are they sacrificing the future for current results? That's one of the criticisms right now of Steve Ballmer, is that Microsoft is all about protecting their monopoly. Well, they have protected their Windows monopoly and made such tremendous profits that they have completely missed the mobile phone market. And unfortunately, the mobile phone market is replacing PCs on a daily basis. I mean, the genius of the iPhone is that we now have, and then all the phones that followed are basically personal computers in our hands that happen to make phone calls. Not always that well, by the way. But the point of the real story is that Microsoft focused so much on its short-term profits, missed the long-term trend. Now they're scrambling to catch up, and they were forced to do this acquisition of Nokia. The flip side, though, is you have some companies that focus solely on the long term at the expense of the short term. Look at Amazon. Jeff Bezos could care less about short term profits. He is trying to build a distribution empire that will rival everyone else and allow him to dominate. And right now, the investors are giving him the ability to do so. Other companies may not have that because they don't have that long term vision that the investors believe in. So ultimately, it's about understanding how companies are managing the balance between the short and the long term and how investors are viewing those companies. Finally, one of the other trade-offs we'll have to talk about is margin and cycle time. These are two key drivers of ROIC, and that's what we're going to talk about next. Now, over the long run, what we know on a cash basis is that whatever cash you generate internally will be the cash available externally to your investors, and therefore that will drive the total shareholder return. Stock price improvements will be based on the essentially cash earnings and dividends that you can pay to your investors. And that will become the return that you can give to your investors. So what we're going to focus on this semester is not necessarily the external perspective, but the internal perspective. And we're going to essentially work both ways. So for example, if I know what the cash you generate is, I know what you should trade at. If I know what you're trading at, then I should be able to back into what cash flows led to those stock prices. And so we're going to have to start getting comfortable working forwards and backwards based on some of this real world data. So let me give you this real example. I've actually worked with both these companies. They're real companies. And this is a story from 2008, but it's kind of critical to setting up the way that we're going to analyze companies this semester as an introduction. So company A and B are in the same industry. They basically sell the same products, the same profit margins. They are expected to maintain these profit margins. They have similar growth rates over time, and they also are perceived to have the same amount of risk. So the only difference between A and B is A had a sell rating on them and B had a buy rating on them. And in working with these companies, A was really struggling with why did they have a sell and B have a buy if they sell the same products at the same margins, the same growth rate for the same risk. And one of the things that I talked to A about was, what's your cycle time? And they said, what do you mean by cycle time? And we're going to get into this a little bit more next week. But basically, cycle time says from the time you borrow a dollar from an investor to the time you collect that dollar from a cash sale to a customer, how long does that take on average? And that's what's called cycle time. And cycle time is really key from an investor standpoint as well as a company standpoint. It's often called productivity or efficiency. And there's a simple formula which I'll give you to help us analyze the cycle time of any company. So I gave the CFO of company A this formula, and we quickly calculated using the 10Ks, his cycle time and his competitor's cycle time. And so the answer was company A cycle time using competitive data was 267 days, and his competitor peers 135. So here's what we mean by business model. So the business model of company A says that as an investor, because you have to do the work before you get paid, I give you a dollar of what's called invested capital. You put it into your business, and then you make 8 cents every 267 days, because it's going to take 267 days to turn a dollar of investment into a dollar of collected revenue. And his competitor earns 8 cents every 135 days. So from an investor standpoint, you have to think about, what would you prefer? Would you rather make 8 cents every 267 days or 8 cents every 135 days? And I think the answer is pretty obvious. So let's just talk about how this really works. If A and B both start their projects at the same time, on day 135, A has zero cash profit because they're not done yet. Because the cash cycle is how long it takes to complete your work. Where B on day 135 gets a dollar of revenue, had 92 cents of cost along the way and generates 8 cents of cash profit. On day 267, A has 8 cents of cash profit now. They get their dollar minus their cost. But on day 270, B has 16 cents of cash profit because they use those same resources to complete cycle number 2. So that's the key point. It's not just about the margin. It's about how long it takes you to earn that margin that's going to be important. Because if I make 8 cents every 267 days, that's about 11 cents a year. If I make 8 cents every 135 days, that's about 22 cents a year. So the real question is, would I rather earn 11 cents a year or would I rather earn 22 cents a year for the same risk? And I think from an investor's, the answer is pretty obvious. By the way, company A is called Raytheon. Company B is called Lockheed Martin. And I was actually at Lockheed Martin last week, and this is one of the reasons why Lockheed Martin is doing well relative to their defense and aerospace peers, is because even though they're all selling to the government as defense and aerospace companies, Lockheed Martin is far more efficient than their peers. Because the government cares about the profitability, the government could care less about your productivity and efficiency. And so Lockheed Martin has a productivity advantage, which allows them to out-earn their peers for the same profit margin. So let's apply this in the real world. So in this case, another company I work with is Royal Caribbean Cruise Lines. And this is, by the way, when you analyze that data, so annualize that data, because again, in order to compare profit and cycle time across companies, we annualize the data. So the 11% per year, 11 cents per year in company A, 8 cents every 267 days, is called ROIC. And the 8 cents every 135 days, annualized 22%, 22 cents per year, that's called ROIC. So ROIC is a combination of margin and cycle time. So back to the Royal Caribbean example. Here is 5 years of historical ROICs, and here are 5 years of historical margin and cycle time. So again, margin and cycle time annualized 7.5%. So for example, in 2007, Royal Caribbean Cruise Line made almost a 15-cent per dollar of revenue profit margin. Took them 709 days to do that on average, based on turning a dollar of investment into a dollar of revenue, which means on an annualized basis, they made 7.5 cents of return on invested capital. So for every dollar of borrowed money, invested capital that they invest in their business, they generate about 7.5 cents of cash. By 2011, they were only generating about 6 cents of cash because their profit margin fell to 12 cents and their cycle time ballooned to 780 days. So why did their ROIC fall? One, their margins went down. Two, it took them longer to make the same margin. The combination of the two lowered the return on investment. And so what you can see here is return on investment is a proxy for cash generated. When I make 7.5% rates of return, 7.5 cents per dollar of investment, I can price that. When I make 3%, I can price that. When I make 5 or 6%, I can price that. 6% is less than 7.5%, which is more than 3. And so that's the point. If the investors expect this rate of return to continue, then they can price that and the stock price is going to be relatively flat. Now, one of the other things we can do is we can compare them with one of their peers. So one of the peers of Royal Caribbean is a cruise line called Carnival. And you can see here the same 5 years of ROIC data for both companies. Now, one of the other things we talked about, spread of creating value, is how it compares to a company's cost of capital. And in this case, the cost of capital of both companies is about 8 to 9% per year over this period of time. So my cost of capital is 8 to 9. Here's their rate of return. One of the things that we notice is both companies, Royal Caribbean, never earned their cost of capital during this 5-year period of time. And Carnival had a positive spread, but then their spread started getting worse over time. This was the impact of the global recession. Basically, people don't go cruising when the recession was really bad. And most importantly, cruise lines actually compete with other resort destinations. So if Disney World or the Bahamas or whoever, cuts their price, well, then people look at that as an alternative to cruising. So right now, vacation destinations have been struggling, so it's made it even tougher for these cruise lines. So here's the thing. as their returns have gone down, what do you think happens to their share price? And if you think about it, which of these two companies' share prices probably did better? So, question one, given Royal Caribbean Carnival, what would have happened to their share prices? Here's the cost of capital. Here's their ROICs. Think about the concept of spread as an investor. I expect 8 to 9. This is what you're delivering to me. So if I don't make 8 to 9, my stock price is probably going down. So in this case, think about this company and this company, and then think about which one is going to do better than the other. Is the second question. Well, and then let's look at the data. Over a 5-year period of time, both Royal Caribbean and Carnival lost value in their stock prices. So if you had started the 5-year period and put the same amount of money into both, you lost money investing in both. Now, why would you have lost money? Well, they had a negative spread. If I'm borrowing at 8 to 9 and making 6 or 7, then I'm not going to get my money back from a cash standpoint, and so therefore my share price is going to go down. Now, if I think about it though, which company would I rather have owned during the period of time? It's actually Carnival. Because even though the trend was down, I still had a relatively better return on investment than Royal Caribbean. So I was relatively losing less money or relatively destroying less value. And that's what you see that the market priced these two stocks. So Carnival went down almost 22% in value. Royal Caribbean went down 36%. So I guess the key point I want to make is that we can actually start to understand why stock prices are doing what they're doing and understand that in a little bit more of a rational way over time. And so that's what we're going to start practicing this semester is these key theories which drive cash flows, which all the institutional investors are using as part of their investment analysis process, are the ones that you're going to learn over the course of the semester. And we're going to start trying to make sense of what's happening over time with some of these real world stocks. And so, again, the theories that we're going to talk about help us understand that. So, back to the concept of spread, this is going to be a key one. So, think about this on a personal example, personal level. Question: if we could borrow at 6% to make 4, would we do it? And the answer is hopefully not. Because if we had a $10,000 line of credit, would we take out $10,000 at 6% to invest at 4? Rationally, shouldn't do that. Well, same is true for an investor. If my return on invested capital is 6 and I can borrow at 8 or 9, why would I want to borrow and invest as an investor at 8 or 9 and invest at 6? I wouldn't. That's why stock prices are going down. So some terminology that we're going to use this semester is that if I borrow money and invest in the company, that's called invested capital. And invested capital has two views, and we're going to formally define it this semester when we reorganize the statements. But how much money came from investors, which also equals how much money went into the projects that we work on. And that's going to come from the balance sheet. 2, what is the cost of that capital on a risk-adjusted basis? And 3, what is my ROIC? The difference between ROIC and cost of capital is called spread. Spread times invested capital is also known as EVA, or economic profit. Now, Stern Stewart, the consulting firm, has registered the trademark for EVA, so we're technically not allowed to use it without paying them money. So the rest of the world, including McKinsey, calls it economic profit because economic profit is not trademarked and it's free, but it means the same thing. So the way EVA can be calculated is we can take our spread times our capital, or think of it this way, if we take our profit in dollars as a percentage of the capital, the ROIC, and we minus out what's called the capital charge, which is the capital times the cost of capital, profit in dollars minus capital charge equals EVA. The book reading will talk about this, and that's what we're going to pick up on Monday and give some examples of this. So we can look at spread as a percentage, we can look at spread in dollars, but either way, over time, that spread must be positive. And that's going to be key to our valuations. So one of the valuations we'll do the semester is a spread-based valuation. So in addition to a cash flow, we'll prove that the spread-based valuation gives us the same answer as a cash flow-based valuation, because it doesn't matter how we do our valuations, the company's worth the same. So therefore, if we use different methodologies, we got to get the same answer. And that's going to actually be key to your final exam. So your final exam is going to be basically given a company's data, create a valuation for them, and prove that these two methods actually give you the same answer. So that will conclude our first class. And again, I look forward to meeting everybody physically in person. And I appreciate you logging in for this GoToMeeting webinar, because as I said, I'm using this as well as a test, because I'll be bringing in some guest speakers, and most likely we'll be using this for their guest speakers to show up, and we'll also be recording it and posting it. So for the future sections today, I'll also have this available on YouTube, and I'll also post a copy of it on Canvas if you need to review any of this. Otherwise, I look forward to meeting everybody on Monday. Otherwise, have a good day.